Well, greetings everyone. Kia orana, tātou katoa, tēnā koutou katoa. Welcome to Te Pūtea Mātua, the Reserve Bank of New Zealand, and it's great to be able to be doing this in person again with you all. It's welcome back. And today I also just want to introduce the folk up here with me. We have Paul Conway, who's the Reserve Bank's Chief Economist. To my hard right, Karen Silk, who is our new Assistant Governor and overseeing the monetary, financial market and general cash area of the bank, and Adam Richardson, who's a Monetary Policy Committee member. And of course, I'm the chair of the Monetary Policy Committee, and we have other members in the audience with us, and I want to thank them for their work over the last few days, which has manifested in this document. As you can see and have read, the Monetary Policy Committee today agreed to increase the official cash rate to 2.0%. The committee agreed it remains appropriate to continue to tighten monetary conditions at pace to maintain price stability and support maximum sustainable employment. We are resolute in our commitment to ensure consumer price inflation returns to back within the 1 to 3% inflation target range. Consistent with the economic outlooks and many risks ahead, monetary conditions need to act as a constraint on demand until there is a better match between New Zealand's productive capacity and demand. A larger and earlier increase in the OCR reduces the risk of inflation becoming persistent, while also providing more policy flexibility for the period ahead in light of the very uncertain global economic environment. The level of global economic activity is generating rising inflation pressures, and these have been exacerbated, as we all know, by ongoing supply disruptions caused by both COVID-19 persistence and the Russian invasion of the Ukraine. The latter in particular has put incredible upward pressure on food and energy prices, which are hitting home globally. The pace of economic growth is slowing, however, globally. There's been a broad-based tightening in global monetary and financial conditions, and this is acting to slow spending growth, accentuated by these high costs of basics such as food and energy staples. European geopolitical uncertainty is also weighing very heavily on business confidence and investment intentions globally. Likewise, the COVID-19 restrictions, they continue, especially in significant regions of China, which continue to exacerbate supply chain disruptions and adding to the cost and complexity of doing trade internationally. Here in Aotearoa, New Zealand, we're pleased that underlying strength remains in the economy. It's supported by a very strong labour market, sound household balance sheets, continued fiscal support and a strong terms of trade. So there are quite a few legs of strength and support in the economy. The reduction in COVID-19 health-related restrictions are also better enabling economic activity, in particular in the hospitality and tourism sectors. But the headwinds to this growth are strong, heightened by the global economic uncertainty and the higher inflation that is always and everywhere internationally at present, impacting on international and, of course, domestic consumer confidence. Asset prices, in particular house prices, have also declined. These reflect, in part, the higher mortgage interest rates, both what we've seen and are signalling, and of course the increase in housing supply that is underway at present. On balance, there's a broad range of indicators that highlight the productive capacity constraints in the economy and the ongoing inflation pressures remaining prevalent. Employment remains above its maximum sustainable level, and labour shortages are now the single largest constraint on the productive capacity of this country. And our own core measures of inflation are above the 3% level. Those are the core measures looking through these international price spikes. So with that and our outlook for the economy, we agreed to continue to lift the OCR, the Monetary Policy Committee, at pace to a level where we will feel confident that consumer price inflation will return to within our target range. We view the projected path of the OCR outlined as consistent with achieving our primary inflation and employment objectives, and doing so without causing unnecessary instability in output, interest rates and the exchange rate. I would like to say that once aggregate supply and demand are more in balance, then the official cash rate can return to a lower, more neutral level, and that is signalled in our outlook also. So having done the introductions, just before I pass, let's just go straight into questions. Thank you very much.
Brian Fallow, New Zealand Herald. Governor, with this more aggressive tightening, what is the message you are sending to the people who actually set consumer prices?
That we are very focused on aggregate demand being restrained to with better match our ability to supply that demand. So we are actively leaning against demand growth until it can be better supplied.
Kia ora, Governor. On inflation, how hard is it going to be to get inflation under control in New Zealand? And can you go into some more of the details about what's driving domestic inflation?
Yeah, wonderful question. The difficulty is always going to be, dare I say it, dependent on the credibility of our actions. If inflation expectations remain well anchored to the middle of our target band, our task will be easier. We will be able to confidently lead the public in price-setting behaviour back to that 1 to 3% inflation target range. If inflation expectations continue to rise based on current observed inflation, that's when the job gets very hard. And, looking back through the history of Aotearoa New Zealand, that was the story of the late 80s, early 90s, starting from a position of no credibility on low and stable inflation. It's a tough job. We are in a very different world now. Independent central bank, clarity on our purpose and our actions today. Domestic inflation pressures. Adam, do you want to chat?
Yeah, so obviously what's going on globally is starting to leak into domestic pricing pressure. So, for example, the ongoing supply disruptions from COVID-19 around the world, and then you've got on top of that the war in Ukraine. And then domestically you have quite a strong labour market, and then at the same time you're seeing some particular strength in the construction sector coming through as well.
We try and, the three parts really is the international price, construction and dwelling-related costs, and the energy prices domestically. It's food and energy.
Kia ora, Governor. Just Mitchell here from News Hub. How confident are you that Kiwi households will have the financial stability to deal with this increase?
We're very confident. The good thing about being a full-service central bank is that we do the prudential regulation, the financial stability work, alongside our monetary policy work. The type of interest rate level, particularly the mortgage interest rate, which what matters to people, the levels that we're talking about are very commensurate with the levels that retail banks have been using to justify the mortgages they have been offering over the last 12 to 18 months. So this type of 6% nominal mortgage interest rate has been the level at which banks have been stress testing their customers on a consistent basis for some time. Now I say that will be for highly indebted borrowers. Of course there will need to be some belt tightening, but that is the purpose of stress testing the lending before it's made to the customers. And remember, the vast bulk of mortgages that are out there were done well before the last 18 months, and they were done at mortgage interest rates not a lot different to what we're talking about now.
Just one quick follow-up, if that's right, just on inflation. How close does this move today take you to getting inflation under control?
As always, the forecasts are subject to no future shocks. So all shocks aside, we are confident this is our best foot forward to provide sufficient restraint on demand to smooth pace that back to matching supply and seeing inflation return back to normal. I do have to say, though, I've yet to be during any intervening period without new shocks arriving. That's the nature of the beast.
It's Rebecca Howard from Business Desk. I just had 2 questions. Do you still see the nominal neutral interest rate around 2%? And secondly, there were a couple of references in the document to the New Zealand dollar being a bit lower and that sort of having a negative impact in terms of imported inflation. So I just wondered, are you comfortable with where the dollar is now? Would you like to see it higher? And is there anything you can do?
Thank you. Good questions. The first one on the neutral interest rate. The danger of always giving a number lets people focus on spurious accuracy. We've said the neutral rate is around 2%. People take that as 2. The neutral interest rate is something that we have to estimate, and there's a range of estimation. And, you know, that range is I won't give you the full widespread range, but it's around, you know, between 2 and 3%. This is the range. The word comfortable or confident that we are acting as restraint is why we are saying we need the OCR confidently above the neutral rate to get the restraint that we need. On the exchange rate, the key issue there for us is to note where the TWI or New Zealand dollar exchange rate is at any point in time, because that's an important variable for a small open economy. Where it goes next, we have no influence. We've seen it easing over recent periods because the difference between interest rates in New Zealand and internationally have been narrowing. So we just have to take as it comes and look through any of the price spikes and make sure that doesn't feed into generalised inflation expectations.
Janae Tibshirani from the Herald. Governor, would you please be able to explain the extent to which the Reserve Bank has factored in sort of behavioural economics when it comes to the impact of higher interest rates on mortgage holders and on the housing market and on the economy more generally? Because we saw with the loosening, we saw people perhaps took that signal and went quite far with it. What risk is there that they'll do the same going the other way?
Yeah, these risks are real that you talk about. The single one that we've talked about a lot in recent times has been, for example, asset prices. Asset prices have in part what you can model based on underlying fundamentals, and then humans enter. And then we have all of the following fear of missing out type behaviours, etc. For our purpose and for the economic forecasts, our modelling and how we have seen behaviour evolve is embedded very strongly in our formal modelling frameworks for inflation. For example, the most important one for us is around how inflation expectations are set. Are they set on what we're currently looking at, or are they set on what the Reserve Bank says is their target range, or are they set somewhere between those two things? And we want to make sure they are more focused on where we will be landing inflation as opposed to what they're currently observing. But historically, we've seen inflation expectations being quite backward-looking. We'll focus on what they're just currently seeing. So it's a continuous challenge to manage and to develop those expectations of low and stable inflation. I would say that's probably the single biggest variable, Paul?
Yeah, I think inflation expectations, there's a lot of behaviour involved in that. Also the housing market. With this MPS, we're forecasting a decline of 15% in housing, not from today, but from the peak late last year. And that gets it down to, what we call a more sustainable level, a level of house prices that's more consistent with the underlying economics of the housing market. So, we're cognizant of behavioural aspects around all of that as well.
Not only just where house prices go, but how people choose to consume or not consume out of the housing wealth.
Just a follow-up question. What would you say to people who would argue that the Reserve Bank has been very sort of aggressive in its OCR outlook, particularly given the average rate on the stock of fixed mortgage lending is still relatively low, which shows that there's a lot of, the tightening is yet to be felt. So how can you be confident in that the OCR can actually go as high as you think?
Our confidence remains the same as it is, and we're very humble and modest. Because the good news is we get to do this every 6 weeks. The bad news for you is that we get to do this every 6 weeks. So we can observe how the economy is evolving relative to our projections and make adjustments as we go through. So at the moment, based on the assumptions embedded in this document and our best estimates, we think that this path for the official cash rate up to near 4% at a peak and then coming off again is the best path that we can follow to achieve our mandate. We can create scenarios where it doesn't get as high as that or where it needs to even go even higher. Those are around the former as, economic shocks are even harder in the negative way, or inflation expectations get away from us. So, we're always striking that balance in this document. I hope that got it, what you're doing. Sitting behind this is an enormous amount of different scenarios, better than, worse than. I think the single biggest behavioural change, and I'm sure Deputy Governor Christian Hawkesby was keen to mention it, is our own behavioural change. We have... we've always talked about least regrets. The future's uncertain. What can we do? At least try to steer away from the worst possible outcomes. For us at the moment, that least regrets would be to have done too little too late. And at that point, inflation expectations are just continuously rising, and the task of putting inflation back to within its range becomes incredibly costly. So that's why we have erred to, risking doing too much too soon rather than risking doing too little too late. I use the word least regrets. There's a regret at both of those ends, but it's around what would you most prefer to avoid. So that is what has changed over the course of the last 3 years as we've navigated this heinous COVID supply side situation.
Could I just add to that, balance sheets, household balance sheets it's still in reasonably in good shape. The labour market is incredibly strong. The banking sector is very well capitalised. So the New Zealand economy is absolutely capable of coping with this rate increase. It's consistent with our mandate of bringing demand back to supply pressure so that we achieve our inflation target. Absolutely.
Well
Giles Beckford, Radio New Zealand. Notwithstanding your modesty and humility, Governor, and following on from the comments made there by Paul, your rate track implies at least 2 50 basis point hikes this year, with following on 25s. There will be those who say that you will do sufficient damage to the economy to tip it into recession. How would you answer them?
First, and we're doing what is necessary with the information at hand and with our remit as it stands. We don't project negative growth in any of the quarters in the period ahead. A recession is often talked about as 2 consecutive quarters of negative growth. That's not in our central forecast. Is it set within a range of possible outcomes? Of course it does. But, I would say that without doubt we need to slow the growth in demand until it is better aligned with the ability to supply that demand. In the absence of that, inflation will keep going higher.
And if I could just ask one other question. You make mention there that fiscal settings at the moment, in other words, government spending, are adding to demand, but you note that it will ease. To what extent did last week's budget make your decisions today more difficult?
Our decision is it's not a trigger point on our decision today from what we saw. We're very confident from the outset, as mentioned in the record of the meeting, is the direction where we need to go with official cash rates. It was more about the pace and the extent. What we saw from the budget last week is an upward tick in demand pressure coming from government in the near term, more than what we had anticipated back from the half-year economic forecast, but relatively small bear compared to all of the other drivers that are going on. The core shape of the budget as projected is still one which over time they become a net drag on demand.
And can I add just the overall impact of that on the OCR track is negligible.
Matthew Brockett from Bloomberg. Just on the OCR track, as Joel said, it implies at least one, if not two, more 50 basis point increases. Is it fair to assume that you want to get those baked in sooner rather than later, or have you now reached a level where you can start to, watch a little bit more what's happening in the economy?
We're always watching what happens in the economy, and I don't want to comment on what pace, that's for us to sit down and for the committee as a whole to discuss when we next sit down. But without doubt, we still believe there's a lot of work ahead of us.
And just to follow up on the neutral rate, you said you think it's between 2 and 3%. I think that the last MPS you had it sitting below, or on average below 2%. So have you raised your estimate of where neutral is?
So no, we haven't. I'm just trying to better explain what we've said rather than focusing on a single point. I know we all naturally anchor to a single point. The graphs and the research papers, I think in the monetary policy statement, I can see Rebecca looking for it, we had a whole special section on it, didn't we? Just a couple of monetary policy statements ago, and in that we've printed the range of estimates of neutral, and I think that range, the full ugly disclosure of how difficult it is somewhere between 1 and 4, I think, is it? Yeah, just to give you a sense around how difficult that is to pin down.
So you aren't able to say at this point whether your current OCR setting is still stimulatory or neutral, or?
We would say that monetary conditions and financial conditions as a whole are now at least neutral, if not tightening. Why do I say that? Because the actual interest rates that people receive are significantly above the official cash rate. What are we doing today? We are just confirming where market pricing had already got to. And I think that's an important thing that people need to remember, is that market pricing, not necessarily bank economists, but market pricing was largely where we have said we are today. So whilst it may surprise some commentators, it wouldn't be surprising the pricing in that sense, that side.
John Mayer from Reuters. Governor, you've mentioned the tightness of the labour market and inflation expectations, but also wages are running below CPI. Is there an explanation for why wages, given the labour market and actual inflation, if not expectations, are lagging? And is there any indication of a change in that?
Yeah. Do you want to chat about that, Adam?
Yeah, sure. So, I think the summary is nothing unusual is going on at the moment with wage inflation. So wage inflation tends to lag, say, CPI and core inflation by a couple of quarters. So we've sort of expected this to happen, and we're building sort of a pickup in wage inflation into our projection. So, yeah, it's nothing sort of out of the ordinary that's going on at the moment.
And just to follow up, you're obviously further ahead on the tightening cycle than most central banks, if not all central banks around the world. Have you had anybody sort of reach out for advice on how your cycle is going and what lessons are for them if they go hard early?
I think they probably check to see if we're still breathing like a canary, but no, we do share war stories considerably, particularly at the Bank of International Settlement meetings we have around the table. But suffice to say, everyone's going in the same direction. Everyone's more or less at the same pace. Starting points were slightly different, basically determined by the starting point for their own economies. But, this is a global inflation pressure, and, the global tightening in monetary and financial conditions is evident to all. When I say financial conditions, part of the equity market corrections we're seeing, the broader financial indices are all to the tighter end. There are some small open economies who have been more aggressive and earlier than us, but obviously we're ahead of some others.
Katie from TVNZ again. Just on the housing market, what do you think the impact that 15% drop and your other commentary around the housing might have on first home buyers, and where we might see that market going in the next couple of years?
Yeah, well, a lower price makes it more affordable to a first home buyer. Whether they have quite reached the levels to meet everyone's demand will be seen, so that is certainly a case. Probably the bigger thing to reflect back on is the real challenge here and why the Reserve Bank doesn't target house prices, because, for example, today we're talking about the level of house prices having declined, but the cost of servicing a mortgage has increased. So we don't have the tools to target house prices or behaviour, but we have to be aware of where they are going and what that means for aggregate demand and for wealth and spending propensities. Well, I do have to say, as Paul mentioned earlier, the type of decline we're looking at is very mild and benign relative to where they have come from. Even a much more significant fall in that still has the level of house prices above where they were pre-pandemic. So a bit of perspective and a scale, I would suggest potential buyers apply to their thinking. We have been more concerned about continued increases in house prices. I personally am more comfortable to see asset prices, including house prices, move towards a more sustainable level, a level at which can be explained by the cost of building versus buying, the cost of renting versus owning. Those are the true underlying explanatory variables of where a house price should be. Recent house prices have been well north of anything, which makes me incredibly uncomfortable.
You mentioned the slowdown in global growth, and yet your forecasts still have trading partner GDP growth holding up well above 3% for the next 3 years. How confident of that can you be, given the most recent news flow out of the two largest economies, for example?
Yeah, great question, Brian, and the answer is it's the best number we've got, but there's a huge band of confidence or, uncertainty, I should say, around that number. Probably the most significant issue for us is that whilst you're looking at an aggregated number of many countries, our trade-weighted partners, China in particular is so important to us, and that is a nation that's going through significant COVID challenges at present, and as well as then the broader geopolitical issues that we're seeing globally. It is a risk variable. I don't see the risk of it suddenly proving to be a lot stronger. It's a risk for us around that China concentration of trade.
Lucy from Reuters, can you just give me some clarity around that drop, a 15% drop in house prices? Are we talking by the end of the year, or are we talking over 2 years, or is there any time frame there?
We're talking from peak to trough in our forecasts. There is a graph in, sorry Rebecca, you're never going to sit there again, are you? I'm going to keep asking you for page references, but in our monetary policy statement there's a graph that shows peak to trough. Paul was very clear to say it's the monthly to a monthly.
Yeah.
What we generally talk about is quarterly averages. So this is where, throwing numbers around 5, 15 or whatever. So peak to the trough of our forecasts. Is that correct?
Yes.
15% decline, which will be proved wrong some way or the other.
So, the peak was probably about November last year.
That's right.
So are we thinking that we'll have dropped that 15? Are we going to do it quickly?
I encourage you to read the document. It's all in there on the page. I can't tell you exactly the date.
And can I just stress that there's a lot of uncertainty around these forecasts, and particularly around an asset price. So we're not pretending that we have a crystal ball with respect to the housing market.
Broadly, what quarter are we talking about?
From November to roughly the very start of 2024.
So end of this year, beginning of next.
Thank you.
Yep. And I think we're 5% through that journey already, 5 out of the 15. Yeah, on that. Yeah.
Janae again from the Herald. How different would your OCR track look if employment wasn't in your mandate? Would it make any difference at all?
No, because both employment and inflation are above our target ranges. Employment is well above maximum start employment. Inflation is well above the target range. So it's the same. We would have to do the same thing, i.e. tighten monetary policy to a significant degree.
There's no conflict there at all.
No conflict there. Wonderful. All right, well, thank you very much. I will take that silence as satiated. Can I just give you an exciting heads up for next Wednesday, I believe. We begin our public consultation on our monetary policy remit. So once every 5 years at least, we are reviewing the remit, The remit is about how we go about achieving price stability and contributing to maximum sustainable employment. And the remit is an opportunity for people to be engaged around insights on any adjustments, advancements we could think of. It will be a long process. You'll get to be involved twice, but I really do encourage people to read and engage. We're trying to make it as user-friendly or as complex as you wish to be. Thank you. Mai taki mai o tā. Thank you again to the committee and my colleagues. Wonderful.